Brown. Welcome to this week's MFB News. I hope everybody is really well and feeling suitably festive. You will note that despite my promise last week, there is no Christmas tree behind me. Sorry about that. I have decorated the house, but I didn't quite get around to putting one in the office. So yeah, I will try to be better for next week's ultimate episode of MFB News for 2024. Hope everybody's good and life has been treating you well. We've got some good stuff to cover off with you today. Changes on swap rates, changes on lender pricing, changes on lender criteria. We're then going to have a little bit of a look at what's going on with house prices and some predictions, revised predictions I might add, for next year. And then finally we're going to wrap up with talking a bit about landlord confidence and where people's heads are at the moment. Okay, so let's kick things off with my most favourite thing in the world, which is swap rates and some good news. Hooray! So as of last night, 2-year swap rates were just over 4%. 1 month ago they were about 4.2 and 1 year ago they were about 4.6. So things are starting to improve most definitely. Very similar story on your 5-year fixes. So last night 3.75%. 1 month ago they were just under 4 and 1 year ago they were just over 4. So actually, yeah, things are certainly looking a bit more rosy. Now what's really interesting is that we're seeing a real mixture of lenders pricing up and down at the moment. Now why is that? I know I've obviously gone on about this in previous episodes, but there's going to be a kind of issue around timing. So for some lenders, they will not have repriced since swap rates increased, and so they're now having to do so. Why have they not reacted sooner? So for some people, maybe it was such that their funding model meant they didn't have to because they take savers money, and so their kind of interest rates, their cost of funds isn't necessarily directly impacted by or significantly impacted by an increase in swap rates. It can also be that for some lenders, their IT systems and systems more broadly within their business are such that they're quite clunky, and actually a rate change is not something they can do very, very quickly. It has to be kind of done over a period of many days or even weeks. So it could be that some of these guys simply have been working on their rate increases, but it's taken time to kind of filter through. So what have we seen? So we've seen 3 lenders put their pricing up. We've seen the Nottingham increase rates by 0.2, we've seen Leeds by 0.25 and Barclays by up to 0.5%. So these are all, as you will notice, for the eagle-eyed amongst you, high street lenders who tend to have a mixed kind of funding model of savers money, retail deposits and also the capital markets. These are also guys who've been around for donkey's years and probably are in some cases using slightly more archaic technology systems. So kind of just underlining the point that I just made about why they're putting their rates up when swap rates are coming down. Now the good news is that there have been some lenders who have dropped their rates in the last week. So well done to you guys. So we've seen Molo bring their 5-year fixed rates down by up to 0.15%. United Trust Bank have dropped their rates by up to 0.5%. West One by up to 0.15% and Keystone by 0.1%. So that's fantastic news. And again, you will notice that these guys are not the people you find on the high street. These are lenders who are very, very exposed to the capital markets. Therefore, their cost of funds has come down. So this kind of paves the way for them to be able to drop their pricing a little bit. Also because these kids are newer on the block, these guys will have more agile IT systems as well. So these guys can actually react to rate changes super, super fast. Now, what's interesting is we've actually seen a run of lenders bringing out, limited edition rates. Now, a limited edition rate is essentially where a lender says we've got our core range of products, but we're also going to bring out maybe 1 or 2 or a handful of rates which are slightly more competitive than those core products, but we can withdraw them at any time. Lenders like doing this when the capital markets are quite volatile, which as we've seen over the last few weeks, they've been moving around quite rapidly. Because what this does is it allows them to have a core set of products, which is kind of their day-to-day rates, but also just a handful, a very small number of rates, which they can kind of withdraw at very short notice without disrupting their whole product range, which really means that first of all, they can react to any market changes very, very quickly because you're not repricing a whole set of rates. And some lenders have literally like maybe 100 rates on their product set. So for some guys, changing rates is a massive task. So it allows them to kind of respond very, very quickly. Now, the limited edition rates that we've seen, so we've seen Foundation Home Loans bring out some rates. So they have got 5-year fixed rates from 5.94 with a 1% fee and free valuation, which is pretty good. TML 2-year fixed rates from 3.94 with a 5% fee Land Bay from 4.69 with a 6% fee, and Paragon have bought out limited edition rates for standard properties, which are from 4.74 and from 5.19% for HMOs. Now you will notice that all of these lenders are specialist lenders, therefore very much exposed to the capital markets, and also probably newer lenders with these kind of snazzy, welcome back to the 80s by the way, using the word snazzy, IT systems as well. So I think all in all, in summary, a good week for mortgages, and actually it's really nice to be kind of coming to the close of 2024, certainly tracking in the right direction. Okay, now criteria changes, and I love criteria changes, particularly when they're kind of making things better for landlords, not so much when they're not. The reason I love criteria changes is that, first of all, it's all very well offering mortgages where your rates are coming down, but actually if no one can get at them because your criteria is so rigid, it's kind of pointless, isn't it? So that's the first reason. The second and third reason is that actually I really do applaud lenders who are constantly revisiting their criteria, their risk appetite, to try and improve and see if they're kind of missing anything, whether they're actually feeling comfortable enough to kind of open things up a bit, because this is only going to serve the landlord market, which can be applauded. So in terms of what we've seen in the last week, and again, there's been some whoppers in the last week. It must be an end of year thing, where people are kind of coming to the end of 24, the lenders are looking forward and thinking, what can we do better? So actually, yeah, great. So BM Solutions, first of all, and this is a really big one, have increased their portfolio limits with Lloyds Banking Group. So essentially, and before this announcement, you could only have 5 mortgages with the Lloyds Banking Group. And this will not just include BM Solutions, it's people like Lloyds, Cheltenham and Gloucester, and other lenders that are kind of slightly more historic, who aren't necessarily lending these days. But actually, lots of borrowers have got BM Solutions mortgages from days of old. And so this 5 property limit was quite restrictive, particularly for those people, weirdly, who wanted a further advance. So if you had a BM Solutions mortgage and you wanted a further advance, and you've got 5 mortgages with the Lloyds Banking Group, they wouldn't give you a further advance, because the further advance would count as a 6th mortgage. So it's been really restrictive for some people. So they have increased the number of mortgages you can have within Lloyds Banking Group to 10, which is fantastic. Now there is a monetary limit attached to that as well. So now you can have up to £5 million worth of borrowing. Previously, this was 3 million. So fantastic news from BM Solutions. The reason this is a big one is that BM Solutions are one of those lenders where they don't change much very often. They do what they do incredibly well. They're a big lender. They do large volumes of business. It kind of just runs itself almost. So the fact they've made such a large change in terms of their risk appetite is fantastic. Now, we've also seen Aldermore make some changes which are not insignificant as well. So the first thing they've done is that they're now accepting properties with no or limited dual demand. So what they've gone on to say is that Aldermore will now consider properties where there is no or limited owner-occupied demand. Instead, we will need confirmation from the valuer that there is ultimately demand for the property on a rental basis and there is a proven market already in place. Now, what they do go on to say is that we don't really lend on true investor-led properties. These are still going to be a decline for them. I give the example of properties where they've been bought and they're typically left vacant, and so as a result there is no proven rental market. The second thing they've done is reduce their minimum property value, so that's dropped down from £60,000 to £50,000. What they go on to say is that for standard individual units, including ex-local authority flats, does include that, our minimum value for HMOs and multi-unit freehold blocks remains at £75,000 as before. And then lastly, they've changed their appetite around ex-local authority flats. So now the maximum number of stories in London, the South East, is 10, and it's at 6 for everywhere else. So some pretty chunky changes there. Now, in terms of the big ones, so properties with no or limited dual demand. So this is actually quite a big one. We do often find properties where the market or the valuers come back and say, look, the reality is there's not a lot of resale demand for this in terms of owner-occupier. But people, and then our clients are saying, but this property rents out so well. You know, there's always people queuing up to rent it. So this is what they're kind of referring to. If you have a property where actually it's getting declined because there's no real demand for people to live in it as a kind of owner-occupier basis, but you've got tenants who are really liking renting the property, this is something they can now consider. The ex-local authority flats, so increasing the number of stories, is really commendable. I wouldn't say that kind of puts them outside of their competitors in terms of having a greater number of floors available. It just means that they're actually probably aligned with lots of their competitors now. And the last thing we've seen in this week is that TMO have gone into portfolio lending. So we've talked about portfolio lending in recent weeks, but just to recap, this is where you have one single mortgage secured against multiple properties. Portfolio lending is something that people often phone up and say, I think I'd like a portfolio loan, and they like the sound of it, and then when it comes to it, they actually realise that maybe it's not for them. So what are the pros and cons? So the pros of a portfolio loan, so it's one mortgage secured against multiple properties, which means you have less administration, essentially. One mortgage statement, one mortgage payment. So just kind of administrating the whole thing is going to be much easier for you. The second thing is that when you look at fees, there's one arrangement fee because it's one single mortgage, there's one set of legals. So one valuation fee. So actually that can bring down some of the costs. The downside, and this is the one that not everybody is aware of, is that if you have a portfolio loan of across, say, 10 properties and you sell one of those properties, you would be forgiven for thinking that if your mortgage was at 75%, and let's say you sold that property for £100,000, the lender would take back 75% of your £100,000 sale proceeds, which is kind of a pro rata of their existing lending, and you would get the other £25,000. The reality is that often that is what happens, but the lenders do have the ability to actually keep the whole of the £100,000, or up to the whole of the £100,000 should they wish. So we have had situations where people have contacted us saying, this can't be right, I'm selling my property, but I'm not getting any money out of it. The lender's keeping the whole lot and using it to make a reduction on the existing debt. The lenders are perfectly within their right to do that. So for those people who are sort of considering a portfolio loan, but also thinking about offloading maybe one or two properties in the next few years, it's probably just worth keeping in mind that it's not a given that you're going to be able to actually realise any of that capital from the sale of the property. But again, in summary, a really good week. It's really nice to see lenders revisiting their criteria, trying to open up the market and trying to support landlords better. Okay, now just a quick nod to house prices for those of you who are potentially thinking about investing next year. So Nationwide's seasonally adjusted measure of house prices rose by 1.2% month on month in November, above the consensus 0.2%, after rising by 0.1% in October. So in kind of layman terms, what that means is that actually November's house price increase was 1.2%, was much better than predicted and also much, much stronger than October. So year over year growth, so November last year to this year, growth rose by to 3.7%, which was at 3.4% in October. Its surge is likely to reflect both the MPC's second 25 basis point cut to bank base rate at the start of the month and a bounce back in demand following the wait and see approach taken by households in anticipation of the budget. Now, RICS survey, the most recent RICS survey, showed price expectations balance soaring to plus 20 points in October, while new instructions to sell outpaced new buyer inquiries by just 6 points on average in September and October, despite the apprehension amongst households before the budget. And there's a whole kind of raft of data about the RICS surveys. The way the RICS do their surveys is done on a kind of confidence rating of points, which actually, until you actually read one of the reports, it's quite hard to, if I just read it out to you now, it would make a huge amount of sense. But in short, the RICS survey is pointing to a kind of stronger market. Now, the other thing that kind of goes into this report, which was prepared by Pantheon, which is an economics company in London, is that they're talking about the housing market and how it's going to be impacted by the change in interest rates. So what they say is that the market has repriced, this is the mortgage market now, or capital markets, has repriced for fewer interest rate cuts from the MPC next year. Since the budget was passed and Mr. Trump was elected in the US, that will mean that affordability barely improves between now and the end of next year. So essentially, because we're not expecting base rate to come down really, really crazily next year, that means that actually in terms of affordability, so people's income versus mortgage costs, that's not going to change much between now and the end of 2025. So accordingly, we have reduced our forecast for house price inflation to 4% year over year rise in December. Previously it was at 4.5%. So rather than expecting house prices to go up next year by 4.5%, they're now saying 4%. They finished their report by saying that we still think the MPC will cut rates 3 times next year. So there you go. For those of you who are thinking about investing, but also those of you who are thinking about selling, this is actually important for you as well. The reality is If you were to hold on your property for 1 more year, you could sell it for probably around 4% more than it's worth at the moment. So not insignificant numbers at play here by any stretch of the imagination. Now, for those of you who watch this video frequently, you will know that I'm a big fan of the Mortgage Works reports that they bring out, where they survey landlords and find out lots of information about how landlords are feeling and what their plans are and all that kind of stuff. So they recently sent out one of their fantastic reports, and I was very eager to read it. And then I saw the data and felt, I'm going to be honest, slightly deflated in terms of landlord confidence, and I'll explain to you why. So first of all, in the report, they talk about the percentage of landlords who are feeling good about various metrics for the coming 3 months. Now, the first one that really surprised me was that 34% of landlords are feeling good about rental yields. The reason this one surprised me is that's like 2/3 of landlords are therefore not feeling good about rental yields. Now, we know that rental yields over the last couple of years have just been increasing massively, and the predictions for next year is that they're going to continue to increase. Roughly sort of between 4 and 5% is the kind of school of thought at the moment. So why is it that if we've seen such a great big increase in yields over the last 2 years, and there's still forecasts for further yields going forwards on earth, would landlords only 1/3 of landlords be feeling good about rental yields? And I can only really think this is linked to mortgage costs. So rental yield actually is literally the value of the property divided by the rental income that you receive. But I think what people are doing is when they've been asked about rental yields, they're actually talking about rental profits here. So my mortgage borrowing costs have gone up, or I know they're going to go up because my mortgage is coming up in the next few months. Therefore, my yields are going to decrease. So I think that's what's going on with that one. Now, the next one is the landlord's confidence in their own letting business, and just 31% of landlords are feeling confident about their own letting business for the next 3 months. Now, this one I totally understand. We've got a lot coming down the road still. The Renters' Rights Bill being the obviously very big one at the moment. Again, some landlords are going to have mortgages coming to an end. They're going to be worrying about the increased cost there as well. So I get why people are maybe feeling not so confident about their lettings business at the moment. The third one that again surprised me, and not so much that people maybe might be feeling slightly less confident in it, it's just the sheer number of people that are feeling not good about it, is capital gains. So we've just talked about the fact that house prices have increased over the last 12 months, and very much the predictions, and these are very confident predictions, is that going into the next year and for the next 12 months, house prices are going to continue to increase. And yet only 18% of landlords are confident about the prospect of capital gains in the next 3 months. So that's 1 in 5 landlords are feeling good. The rest of you are not. Now, looking at these numbers, I think what I'm really feeling here is just a sense of people. I don't actually think that 4 out of 5 landlords think they won't make any money on their properties in the next year or so, or 3 months, because we know house prices are increasing, and the data is there. So I don't think that's one that we can kind of really argue. I think what this is actually just an overarching sense of landlords being just fed up and feeling very nervous about the future. And again, this is more, I think, around the Renters' Rights Bill, mortgage costs, all those kinds of things that are in the ether. So really, really sad to see. Now, actually, these numbers on just sort of face value feel very damning. You never get like 100% of landlords are feeling good about capital gains. You don't see those sorts of numbers, but these are distinctly lower than you would normally expect. So therefore, I guess it's no great surprise to see that 14% of landlords, just 14% of landlords, are planning on buying in the next 12 months. Now, normally that wouldn't be a particularly shocking statistic. But when you balance that with the number of landlords who are planning to sell, 45% of landlords are intending to sell a property in the next 12 months. That is absolutely huge. So really what we're seeing here is just a really large number of disenfranchised landlords. Now, will 45% of landlords sell a property or more than one property in the next 12 months? I suspect not, if I'm really honest. When people are feeling very kind of negative about the market, feeling unsure, they do contemplate very seriously selling properties. When it comes to it, do they actually do it? Not necessarily, is the honest truth. But actually, I think it's just kind of really sad to see our wonderful community feeling quite so negative at the moment, when the reality is that, house prices are increasing, therefore your capital gains are going to grow. rents are continuing to increase on the back of 2 magnificent years of rental increases. Void periods are down to their kind of all-time low. So if your property becomes empty and you relet it, it's going to be refilled very, very fast. So I think really it's all about the legislation for landlords at the moment. So yes, not a great report, I'm afraid, but actually I'm really hoping that when we come back to the report in next quarter, you guys will be feeling slightly more positive. God, I just want to end this video by saying keep your chin up, guys. It isn't all that bad, I promise. Actually, on the Renters' Rights Bill, because I know that it's such a big thing for people and people are really nervous and very, very kind of worried about it. We did do a webinar, I did mention it a couple of weeks ago, where we had a solicitor, an insurance person and a lender on panel, and we talked for around 45 minutes about the Renters' Rights Bill, and it was really fascinating. There was some really good stuff in there. And actually, while there are some things that could be a real problem for landlords, actually there are some solutions that might help to kind of balance them out, at least to some extent. So if you haven't seen the webinar, I'd really encourage you to have a look. It would be a good investment of your time. And that is everything for me this week. Wrapping it up, like I say, next week's going to be our last MFB news for the year, but obviously the office is currently very much open all the way through to the new year. So if you do have any questions, we would love to hear from you. 0345 345 6788, or you can email us inquiry@mfbrokers.co.uk. Have a fantastic week, and I will see you same time next week.